Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 1.71% year to date as of February 24th, 2024. Our goal here at Spy Trader Now is to beat the returns of the S&P 500 buy and hold investor. They are up 6.85% year to date. So they are surpassing us, and our goal is to beat them before the end of this calendar year. Here are some past returns for the model portfolio. Last week, the S&P 500 gained 1.67%. We're going to go through the charts in much greater detail later on. I made no trades last week. Here are the trades we've made in 2024. There are 3 open positions. We currently hold 200 shares of SPY. We're up $4,000. We have an in-the-money covered call. If I was to close it today, I would have to pay $3,000 in an effort to close that trade. And that is taken into consideration with this account right here. And we have one long call, one contract for a long call, and we are up $506 on that trade. And on a percentage basis, we're up 29%. Unbelievable good position so far with that call. And here is the equity curve of our model portfolio for 2024 year to date. Here is the equity curve of the S&P 500 for 2024 year to date, practically a straight line. Here are the 2 equity curves combined because we always want to compare ourselves against the benchmark of the S&P 500 buy and hold investor. They have just been on a complete tear. The chart shows it, their returns show it. I mean, it's unbelievable. Here's the Fed Chair, Jerome Powell. The next Fed announcement is about 1 month away on March 20th. Are we going to have a 25 basis point rate hike, a cut, or a skip? Here are things looking at it from the presidential election cycle theory. Depending upon the year of the election, has historical rates of returns for the S&P 500 and for the NASDAQ 100. Currently, President Joe Biden is in the 4th year of his term. Historically, for the S&P 500, that averages 6.7%. We are up 6.85% year to date, telling us that either from an historical basis, there's either not much room left for growth, or we'll continue to grow, then we'll correct down, and so forth throughout the calendar year. So only time will tell. Now we're looking at things from the bond market outlook, which says stay out of the stock market for 2 reasons. Number 1, you have an inverted yield curve, and number 2, you have rising interest rates. So we are monitoring this, and we're waiting for this yield curve to go back to normalization, which it should, but it's been like this for a long, extended time. Now, there's our friend Warren Buffett, the Oracle of Omaha, and here is CNN Business Fear and Greed Index, and we are in extreme greed. Now we are looking at things from a seasonality outlook, and for the last 20 years, in the month of February, the S&P 500 has closed higher 60% of the time from when it opened. Currently, for the month of February, we are up 5.17%, an incredible growth in 1 month for the index of the S&P 500, leaving plenty of room for it to come down and still close positive for the month. Also, we are up 6.85%. Historically, the S&P 500 on average it has an increase of 7.52 to 10%, 10.41% annually. So on a historical basis, this is extremely strong for the trading this year. Now we are looking at things from a long-term 20-year monthly chart, S&P 500, and you can see that we are in a long-term bull run. This angle of ascent is pretty much unsustainable. This is going to flatten out, and it's going to change its angle from this straight up to the trees to something else. Now we're looking at an intermediate term outlook, 5-year weekly candlesticks. And right now you can see how well we have done over the past so many weeks with only 2 red candles. We are in, if you see this channel that's right here, we're in this trading channel. You'll see it better on the next chart. Now here is a 6-month daily candlestick chart. This is that trading channel I was telling you about. We are basically bouncing in and out of this channel. We are currently bounced off the bottom. We're coming up to the top, and we should theoretically, the expectation would be for us to either reach it or come near it, and then either soften and flatten out, or come back down until we reach this level of support. The bottom line is this: we are now in an upward trading channel until we're not. So until this breaks out, I'm going to continue on with my long call, and I'm going to keep my in the money call option going just until this market has a correction. There's a Fibonacci retracement here, grabbing it from when we started here way back somewhere in November to where we're at today. And I've got a retracement of 38.50 and 61.8. So once we pull back and hit one of these Fibonacci retracements, I'll buy to close my in the money covered call, and then just be long the stock, and then pick up some more long calls. So that is my expectation for trading for the remainder of 2024. Now we're looking at a ratio chart of the NASDAQ 100 to the S&P 500. And what I am looking at is that we are in a trading channel, and we are at the bottom end of this trading channel. As long as we stay in the trading channel, the market is going to continue to advance. But if we break down below this support line and stay below it, odds favor that we're going to have more of a correction than what we've been used to over the past 9 or 11 or 12 weeks. Now we're looking at another ratio chart of the equally weighted S&P 500 symbol RSP to the normally cap-weighted S&P 500 symbol SPY. There are 3 charts here. The ratio chart's in black and red. In lime green is the equally weighted S&P 500. In dark blue is the normally cap-weighted S&P 500. Now, we have fallen off of a cliff twice in the last 20 years when the ratio chart has fallen off of a cliff in the last 20 years. It's fallen off of a cliff 3 times on the ratio chart, but the S&P 500 only had small corrections with, well, I should say, they didn't have small corrections. They had significant corrections at the same time that the ratio chart fell off of a cliff. The S&P 500 has not experienced this correction yet. So in the 2020 correction, when the ratio chart fell off of a cliff, the S&P 500 experienced a 19% correction. In 2008, when the ratio chart fell off of a cliff, the S&P 500 from this point, not from this point, from this point down to here, experienced a 40% correction, significant correction. We are up here in the trees. The ratio chart is down here below the ground. So it just gives more evidence that eventually this euphoria is going to come to roost, and this is going to correct back down somewhere between 19 and 40%. Now, a couple things I've been observing here. On the 40% correction, that was after the market showed significant weakness over time. On the 19% correction, it basically was doing what it's doing now. It just kept going up, 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 and then one day, boom, down dramatically fast. This is a weekly chart. Basically, over 2 to 3 weeks, the S&P 500 lost 19%. Now, with my in-the-money covered call that I currently have on the books, I'm going to profit as this thing falls. Of course, I'm going to lose money in the S&P 500, But on the in-the-money covered call, I'm going to profit because that in-the-money covered call is going to gain money, or so I can buy to close it with less dollars than where it's at now. It's going to lose money, which in effect will be profitable for me. And then I can buy to close it, and then when the market corrects, I'll be advancing there. So I'll be making money theoretically on the way down and on the way up. That's the advantage of the current strategy that I'm doing. Now we're looking at things from the VIX Volatility Index, otherwise known as the Fear Index. Right now we are in the ultra low range below this green line. This is the low range between these two green lines, and this is the upper range. The S&P 500 will continue to advance as long as we stay below this green line, and we are clearly below it. It's trying to break out, made a couple of advancements, but it keeps coming back down here and staying in this ultra low range. As long as that happens, we need to be long this market, and it's okay to put leverage on. Now we're looking at the Thinkorswim platform, and this is the S&P 500 5-year weekly chart with standard deviations of +2, -2 in gold, +1, -1 in pink, the regression 50% line in dashed green. Currently, you can see the nice run that we've had, and we are now traveling north. Now we are looking at the same Thinkorswim platform, but instead of going back 5 years weekly, this is going back 1 year daily. On this chart, you can see that we are right at the +1. We're just below it, 0.9 standard deviations. As soon as we hit the +1, there's going to be a 68% probability that we're going to bounce off of that and either go flat or come back down. So the higher you go, the higher the probability is that you're going to stop advancing. Now we're looking at the same chart, but only going back 6 months daily. Here your standard deviation is only at the 0.75. So it's about 3/4 of the way between the 0 and 1 mark. And it is right in between the sell zone and the buy zone. So it's in this twilight zone. Now we are looking at an asset class strength chart against multiple asset classes and against the 11 sectors of the S&P 500. I monitor this. Here's the information and how I derive it, and then I come to a color guard signal. And I also compare last week's reading with this week's reading. Now, for the 11 sectors, last week was 86%, this week is 86%, that's staying flat. And for multiple different asset classes, there's a little bit more strength, from 79% to 81%. Now we are looking at a 1-year chart of the 10-year bond yields. Now, we came down, we bounced, hit support, came up to this resistance level, bounced off of that, came back to support, did a double tap, and now came up. But instead of this resistance line acting as resistance, you can see how it sliced right through it to the upside, came back down, retested it, and then bounced over it. Now, I thought that the market, due to the higher bond yields, the higher the bond yields, the less enticing it is for equity investors. Now, the bond yields here are coming up, and the S&P 500 is still coming up. Now, if this continues to advance, that will eventually have a negative effect on the S&P 500, like it did from here to here. You can see the S&P 500 corrected from here down to here. But in this case, the S&P 500 is absorbing this upper level. Now, if it continues to advance, that will change. And it may even change even if it stays at this 43 level. We will monitor this. So I just gave you a ton of information in this video. Now comes the critical thinking. What are you going to do with this information? Well, as of February 24th, 2024, the market summation, according to me, your friendly host, Ken, with SPY Trader Now. The market strength has been strong. We all know that. I have been too conservative. Yes, I completely recognize and acknowledge I have been too conservative. But I had some FOMO, fear of missing out. So I took on a call. I told you about that call, and I took on the exact call I told you I was going to take on. I am currently profitable in that call by $506 or 29%. Gee, Ken, if you're so profitable in that call, why didn't you take on even more calls and sell some of your stock and totally leverage out? I don't have that much faith in this market. I think we're closer to the end of this upward trajectory than the beginning of it. So I'm going to keep this long call on, and I'm hopefully going to close out of it with profit still in my pocket. But I'm going to be watching that trading channel I showed you on the 6-month chart. As long as we stay in that trading channel, I'm going to keep this long call on. If we come out of that trading channel to the downside, I am going to close this out, hopefully maintain some level of profit. And then, of course, I'm going to keep my shares of the S&P 500 and the in-the-money covered call, because as the market comes down, I'm going to make money. That will conclude this video. I hope you've got some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell. Do me a solid. You've gone this far. Hit that like button for me right now to help me promote this video. I thank you, and I wish you good trading.